What are the 7 most common money mistakes people make during tough times? Plus, we'll also have the 6 myths about Social Security that you need to know. Welcome to the program. Happy Labor Day weekend. I always find it a bit ironic, I guess, that we celebrate Labor Day with getting a day off, but hey, I hope you're enjoying your 3-day weekend. Labor Day traces its roots as a federal holiday all the way back to 1894, so it's one of those federal holidays that's certainly been around a long time. Started back then as an honor to the American labor movement and the workers who helped make this country great. So yay, labor, and certainly we appreciate the extra day in the weekend. Like so many Floridians, we're probably going to the beach or something like that, so make sure you stay safe, socially distance, wear a mask, all that good stuff. If you are a regular subscriber to our YouTube channel, you will notice that my appearance looks definitely like a 3-day weekend on the program this week, because normally we treat this show very seriously and we wear a suit and a tie and all of that whenever we do the program, but today we're actually not at our house, we're over at the beach, and so consequently we're a little bit more casual today. So if you view us on YouTube, you'll notice, well, how come Joel's not in a shirt and a tie? I don't think I've ever seen him not in a shirt and a tie. That's partly because we're at the beach. It's also partly because I kind of forgot to bring it in my stuff that I packed. Anyway, so hopefully though the quality of this show remains just as good as it normally is, even though I am not wearing a tie. Interesting stat that I saw this past week. Oh, I also didn't shave either, so I'm looking like definitely a 3-day weekend. Interesting stat I saw this past weekend that 8% of counties in the United States touch a body of water, whether that's the Atlantic, Pacific, Gulf of Mexico, Great Lakes, whatever the case may be. 8% of all counties, but yet of those 8%, 29% of the population of this country lives in those countries. So we clearly have an affinity here in this country for our water. So we hope you're having a great Labor Day weekend. Welcome, of course, to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you simultaneously on the News Radio Orlando network along with 96.9 The Game. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. Just crossed 12,000 downloads of our programs on the web. So we certainly appreciate our listeners and subscribers on things like iTunes and Spotify and iHeartRadio. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this very week to help you change your life with a successful financial plan that provides you with peace of mind for the future. So I think we do have to spend a little bit of time on the program this morning talking a little bit about the markets, right? So September, particularly, should I say, the last couple of days, business days of late, Thursday and Friday, saw a dramatic increase in the level of volatility in the market, particularly, of course, on Thursday, where the Dow dropped 800 points. That was a 3.5% drop. That was, again, to put perspective on it, the worst drop since June 11th. So that's like 2.5 months. So certainly something that kind of happens on a somewhat regular basis. Also coming on the heels of perhaps the best August. Well, it was not the very best August, but it was the best performing August in 34 years. So for the month of August, and normally August is not really that good of a month because people are on summer vacation and trading volume is light, and so you just don't have the fixation on the market like you normally would. And of course, this year during COVID times, that's I guess not the case because not many people are able to get away on vacation. So it was an abnormal August in a lot of respects. Certainly though, from a market perspective, it produced a record return that we hadn't seen a return as strong for that particular month in nearly 34 years. And then, of course, the first couple of days of September added another couple percent as well. So what's really surprising about all of this is just how far the market has come in such a short period of time, right? So when all of the COVID stuff and the shutdowns and all of that were sort of at the peak, and uncertainty was at its highest point, although there's still a lot of uncertainty out there about this now, that period of time was in March. So if you look at where the market fell to, specifically on March the 23rd, and you go through last Friday, so August the 28th, the last kind of full day, although there was another day in August here, and that Monday, but through August 28th, the S&P 500, which is probably one of the broadest gauges of the overall market, the 500 largest companies in America, gained 58%. So from March 23rd, August 28th, little over 5 months, a 58% increase. And that's really amazing when you stop and kind of think about that, because we still have the pandemic going on. There hasn't really been any real solutions on that. Maybe the medical treatment has improved, so you're not as likely to die from this versus back in March. But it's still just an unbelievable period of time when you think about the headlines. And so I think there's really, in light of what happened on Thursday and Friday in terms of the market reaction, the market decline, and the fact that the market is up so much within a 5-month period of time, I think there's really 3 takeaways, and I guess I would add in 2 warnings as well that investors should be thinking about these days. So number 1 is one that we talk a lot about on this program, and it bears repeating, and that is that volatility is normal. Now understand, volatility, it always has 2 sides. It can mean that things are going up. It can mean that things are going down. That's the definition of volatility. It doesn't just mean all up. It doesn't just mean all down. It means both. So if you think the market goes through just kind of the straight line type of approach, that's not exactly anywhere near what the market's behavior typically is. And particularly when you go through a period of time where the run-up was so strong, 58% in 5 months is just really pretty amazing. You have to be prepared for additional volatility ahead. When something goes up 58% in 5 months, that's the definition of volatility. Prior to that, in reaction to COVID, there was about a 35% decline within about a 30-day period of time. So again, down 35, up 58. That's a pretty textbook definition of volatility. So just be prepared for that. Interestingly, there's been 26 other times since 1950 where the market has gone on an increase, an upward trend for 5 consecutive months. We've just seen it, what we've just experienced, April, May, June, July, August, 5 months. The market, each of those 5 months was positive. You don't often see 5 months strung together where it is positive, again, because volatility is normal. There's only been 26 other times where we've seen a span of 5 months where every single one of those months in consecutive order was up, and that has happened, like we said, 26 times since 1950. So remember, volatility is in fact normal. Number 2, volatility does not mean that a market crash is around the corner. Let's take a second and look at those other periods of time, those other 26 occurrences where the market was up 5 months in a row. What you'll find is that 96% of the time out of those 26 occurrences, or pretty much nearly all of them, you'll find the market in fact higher 12 months later and with an average gain of 13%. So some interesting numbers in terms of those strong positive trends that lead to volatility, but also over time can produce some positive results. So, and then thirdly, volatility presents opportunity. And it's that opportunity and those 2 warnings that we want to talk about after the break. So when we get back, we're going to talk about One other piece of information we want to share with you for some perspective, if you will, on what's happening now in the markets, and then also talk to you a little bit about those two warnings when we continue here on Dollars and Cents. This is Joel Garris on News Radio WFLA Orlando. On the program, we're talking about the 3 takeaways that investors can make of the market given what went on last week, particularly last Thursday with the 800-point drop in the Dow. Plus, we also want to give a couple of warnings. So before the segment, we were talking about the first 2 takeaways, if you will. Number 1, volatility is in fact normal. And number 2, volatility does not mean that the market is setting itself up to just fall 50%. Volatility is a normal part of the markets over time. Number 3, volatility presents opportunity. And maybe it's an opportunity that you've sort of been struggling with, because if you look at the amount of savings that has happened even during the course of this pandemic, what's kind of unique is that the savings rate has increased dramatically. The amount of money sitting in cash has increased dramatically. And some of that, I suppose, is from less spending. But the reality is that there's also been a lot more money put into the system. So the numbers, when you look at it on a personal basis, are really kind of interesting. When you look at the savings rate for the month of April of this year, for example, reached a high of 33.5%. That was a personal savings rate. Again, some of that's because nobody was able to go out and spend any money because everything was closed and everybody was sheltered at their house. But if you compare that to the savings rate of the year before, April 2019, you'll find that that's about 7.5%. That's a pretty significant gap in terms of the savings rate and the portion of money that people are holding on to. And then if you look at just the sheer number of what that means in terms of cash, and this statistic looks just at money market accounts, what you'll find is there's been a 28% increase in the overall balance of money market accounts since the beginning of the year. So to put that into actual dollars, beginning of the year there was about $3.6 trillion sitting in money market funds. Today that number is about $4.6 trillion. So it's an extra $1 trillion, give or take, that is sitting there. And like many people, if you've got that cash sitting there and you're looking at it and you're saying, oh my goodness, that's making like nothing. I mean, this is just crazy that this money is sitting there and it's making zero because of how low the interest rates have been pushed down during the course of the pandemic. It really is impossible to get any level of return on cash or money market types of savings, particularly when you consider inflation normally runs at 2 or 3%, and then you have to pay taxes on whatever interest it is that you make. You're not getting ahead by just simply leaving it sitting in cash. So we say that volatility presents an opportunity because maybe you find yourself in that position where you've got more cash, you've got extra cash, and so you're looking at the return and saying, I don't necessarily need this much money just sitting in cash, but I'm concerned about the volatility of the market. Well, understand that volatility presents opportunity whereby you could take some portion of that money and add it into your investment accounts. Don't make it an all or nothing decision. I say to people all the time, don't make investing money an all or nothing decision. Make it a decision that you make incrementally along the way, where you're putting money in on a regular basis, that you're using volatility to your advantage, whereby if you see the market kind of trending down, that's a good opportunity to try and take some of that cash off the sidelines and invest it. So remember, make sure you're using volatility as a opportunity rather than just simply using it as an opportunity to further sort of dive underneath those covers, which you may very well be doing on a Labor Day weekend. Of course, we mentioned in the beginning of the show We're away this weekend. We're still doing the show live because we do everything outside of the studio now. All of this post-pandemic, or not really post-pandemic, in the middle of the pandemic environment, we are doing the show through the magic of the internet, the computer, all this technology. When the folks at the studio brought over all of this stuff, I've got like a full bag of stuff that I have to carry around with me in order to do the show. And except for the fact that I forgot, because it's Labor Day weekend, I forgot a shirt and a tie, which normally I, kind of dress and be ready for the show. So we're very casual today. Also, not shaved too. So if you follow us on YouTube, you'll see that we're a lot more casual than we normally would be here on the program. But anyway, regardless, welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris, and I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this very week to help you change your life with a successful financial plan that provides you with peace of mind for the future. So those were the three takeaways for investors, right? Volatility is normal. Volatility it does not mean that the market's going to go down dramatically. Volatility presents opportunity. Now, we'll give you the two warnings, right? So if you're invested, you need to stay invested. That's warning number one. Don't jump in and out of the markets with dollars that you have invested. You're going to get that wrong. Ask anybody who got out of the market in March what the hardest part of that decision is. It's not the decision to get out of the market. That one is super, super easy. It's always easy because you're working off of emotion, you're making decisions based upon emotions, and ultimately you wind up simply taking and making a move that at the time makes you feel good, but then the much harder part of it is trying to figure out when to get back in. And that's the piece that people are really struggling with and trying to figure it out. So bottom line, if you are invested, you stay invested. And then number two, check your diversification. We've talked a lot about this in some programs this summer. The reality is that a lot of the market is structured or is performing based upon the performance of a handful of companies: Facebook, Amazon, Netflix, Google, Apple, Microsoft. Those small handful of companies are driving a lot of the performance. The latest numbers on it, just to give you some perspective on it, is those top 5 stocks that are all those tech, social media type or software types of companies. Those top 5 drive 40% of the performance of the NASDAQ. So just watch that, check that. I think that would be the warning that I would give to all investors, is to make sure that your diversification truly is diversification and you're not getting quite so heavy in those 5 companies that really are driving things pretty dramatically. So just watch out for that part in terms of your overall portfolio. So make sure you're doing the analysis, drilling down a little bit deeper in terms of what's the overall allocation, how much percentage of this particular company is in my portfolio, in order to make sure that you're not getting so concentrated on those companies that are taking a lion's share in terms of the performance. Because what happens is, then if something starts to deteriorate with those companies or with that sector, then you're going to be feeling that disproportionately in the value of your account. So some key takeaways and a couple of warnings there for investors to consider in light of what's going on in the market over the course of not just the past couple of days, but also really the past several months. So speaking of some things that have made some headlines of late, there are so many myths and so many misunderstandings of Social Security these days, and we thought we would take a moment in the program to talk a little bit about some of the more popular myths and ultimately sort of go through the process of giving some perspective, maybe not fully debunk some of those myths, but really go through the process of trying to give some perspective. And we've got 6 of them, if you will, and we teased at the beginning of the program, the 6 myths involving Social Security. So we're going to dig into that at great length in our next segment. So we'll take a break. When we come back, we're going to return here on Dollars and Cents and talk about the 6 myths about Social Security coming up next here on the program. This is Dollars and Cents with your host Joel Garris of Nelson Financial Planning on News Radio Orlando, along with 96.9 The Game. So many myths, so many misunderstandings about Social Security. We're going to tell you on the program today some of the 6 most common ones and help to perhaps provide some perspective on it. Welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you live here on Sunday morning on a Labor Day weekend. Hope you're enjoying your Labor Day weekend. A little bit casual for our YouTube audience. Normally we got a suit and a tie on and all that good stuff, but definitely feeling a 3-day weekend here on the program. You're catching us here on Sunday morning on either the News Radio Orlando network or 96.9 The Game. For those of you who will catch us later on this week on one of our many social media channels or places like iTunes or Spotify or iHeartMedia, we're one of the top 25 financial planning podcasts on the World Wide Web with over 12,000 downloads of our episodes. My name is Joel Garris, certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this very week to help you change your life with a successful financial plan that provides you with peace of mind for the future. So, what are those 6 more common myths out there? Well, the first one, probably the most common one that you hear an awful lot about, is that Social Security won't be around. Social Security is not going to be around. Folks, that is a myth. That is not fact. The reality is, when you hear about these statistics where the Social Security program is projected to run out of money, that's not exactly an accurate statement. It's projected to run out of the ability to pay the level of promises that it has made. It is not projected to run out of money. If we do nothing, worst case scenario, it is a reduction of benefits of about 25%, which again is not good. But the reality is that it's not going to go from I'm collecting my $1,800 a month of Social Security and then the next month it's zero. Social Security not going away. And yes, in fact, if you're not on Social Security, it will be there. It may look a little different. You may have to wait until you're a little older to collect, but it will certainly be there. Number 2, and hopefully this is a myth that everybody recognizes, is that Social Security is not all you. Social Security is sort of all you need, right? If you get to retirement and then you're just collecting Social Security, that's really all you need. Not at all. The program, in fact, was not intended to be set up as the sole source of your income in retirement. It's meant to replace about 30, maybe 40% of your income. So that means that it's up to you to figure out how to get the other 60 or 70% replacement. So understand that Social Security is not going to be all you need. You're going to need more, and you need to be planning for that along the way. Remember, you don't just wake up and have millions of dollars. The story we told last week on the program, that young couple, and we actually talked with them this week, and when they came in initially back in 1989 and started investing with $150, that's all they had. They were late 20s, early 30s, 4-year-old daughter, started with $150. Today they've got an investment portfolio that's over $3 million. They started with $150. Normal people, the reality is that you need to start early, you need to start regularly. You don't need hundreds of thousands of dollars to start, just get started. So then that way you can make sure that you're not solely dependent upon Social Security, because you're going to need more than just that. Number 3, the strategies that you hear all manners of when to file, right? There's this camp of folks that say file as early as possible, and then there's this camp of folks that say file as late as possible, because if you file early, it's subject to a permanent reduction. If you wait and file later, it's not going to be reduced. And then if you wait past your full retirement age, you get an extra 8% per year added into your amount. So you get sort of these, 2 different camps, if you will. File as early as possible, file as late as possible. And I think the answer really is it depends. I think more often than not, we would lean towards the side of file early, but everybody's situation is different. Everybody's situation is unique. And I think it's important to really look at the projections that you have for your Social Security, along with what the rest of your picture looks like in terms of how much have you saved to help provide retirement income that's going to supplement that Social Security. That's one of the reasons back in the office we have individuals on the team that are national Social Security advisors to help folks with those projections and with those numbers in order to make good decisions for what is unique to that person. So I think generally, if you had to push me to a camp, I would say take it sooner rather than later in terms of Social Security. But both of those camps, we take it as early as possible, take it as late as possible. There's some validity depending upon what your personal situation is. So don't rely on generalizations. Have someone run an actual analysis, an actual projection in terms of what your Social Security is going to be. Number 4 on our list of the 6 most common myths about Social Security is that if you don't work, you're not going to get any benefit. That's not true, actually. Even if you haven't worked for the requisite 40 quarters that you have to work in order to become eligible for Social Security on your own record, you can still, in fact, apply on your spouses, or even in the case of ex-spouses. So remember, you still may be eligible for benefits even if you don't have those benefits available under your own record. And of course, as a survivor benefits wind up getting you full benefits based upon your spouse if they have predeceased. So just know that even if you haven't worked, there may still be the ability to get benefits as well under Social Security. And then number 5, if you've never worked, the notion of never working after you file, that's not true. You can certainly work after you file. The thing you have to be careful about is that if you are under your full retirement age, which for most people is approaching 67, the reality is that if you take Social Security early, then it's subject to a limitation on the amount of earned income that you can make. So what that means is that you basically, earned income is not retirement income, it's not pension income, it's not rental income, it's earned income. You're going to a job, you're working, you're punching a time clock. If that number is less than 18,000, you can certainly still work and collect benefits. If it's more than 18,000, you probably want to think twice, because what happens is the more the income goes above 18,000, if you're under your full retirement age, then you wind up potentially having to give some of your Social Security back. If you're over your full retirement age, then you're fine, you don't have anything to worry about. But the reality is that you need to be aware of how working and collecting Social Security sort of interrelates. If you're past your full retirement age and you are still working and you are collecting, well, hey, that's great. Good news is that your Social Security benefits are actually going to go up a little bit more as a result of that extra year of working. Not a crazy amount, because remember, Social Security based upon the average of 35 years of work. But if you're still working, replacing a year of those 35 that might have been a 0, yeah, you may find that there's a little bit more of a bump in your Social Security as a result of continuing to work. And then lastly, and this is always one to be aware of, don't take advice from the neighbor across the fence. Family, friends, often well-meaning, but the reality is that it's never a good idea to do anything financially based upon some advice that you got in passing. There are experts on this topic of Social Security, the professional designations, National Social Security Administrator being one of them, and so certainly our advisor, not administrator. Certainly those types of professional designations are important to ask, and make sure you actually get a projection that compares the options when it comes to Social Security. So those are sort of the 6 more common myths and misunderstandings of Social Security. We hope that here on Labor Day weekend we've helped to give you some perspective, right? You're working, laboring, you're putting in money to Social Security. You want to make sure that it's still there. You want to make sure that you're making good decisions on it. And so we thought we would spend a little bit of time on today's program talking a little bit about Social Security and some of the myths and misunderstandings to help give some perspective on that. So we're going to slide to the break. When we get back, we're going to talk about the common money mistakes that people make during tough times and, more importantly, how to prevent them. Coming up next here on the program after the break. This is Dollars and Cents with Joel Garris on News Radio WFLA Orlando. So what are the common money mistakes during tough times that people make? And more importantly, how do you avoid them? We got 7 of them we're going to share here on the program. Welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you live here on Sunday mornings. Happy Labor Day, by the way, on the News Radio Orlando network, along with 96.9 The Game. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. Thanks to the folks at FeedSpot, and now over 12,000 downloads of our podcast episodes. So good stuff there. So check it out if you want to catch the program during non-Sunday morning. Maybe you're sleeping in this morning because it is, after all, Labor Day weekend. My name is Joel Garris with Nelson Financial Planning. I'm a certified financial planner, certified financial fiduciary. Our team of certified financial fiduciary stands ready this very week to help you change your life with a successful financial plan that provides you with peace of mind for the future. So 7 most common mistakes that people make with their money during times of pandemic. We'll start right off with the first one, which if I had a nickel for every time I've heard this, I'd have a lot of nickels. I'm going to stop contributing to my retirement plan, whether my 401k, my deferred comp, my 403b. I'm going to stop contributing because the market's going down, or we've got uncertainty, or we've got tough times. Folks, that's just too easy of a reaction. What always startles me on that is folks say, I'm going to reduce down what I am putting into my retirement because the market is going down. Folks, when the market goes down, that is an opportunity. We talked about that early in the show. Volatility is an opportunity. It's an opportunity for you to continue to invest. And when you're able to invest and the market is lower than what it was, you're buying more shares. It's kind of like if you go into a store, make sure you wear a mask, of course, in today's world. But if you go into a store and you see like Publix, the BOGO, right? You don't probably need 2 of that, but it's buy one, get one. So you buy one in order to get the other because it's on sale. When the market is down and you're investing money, it works the same way. So don't stop, don't reduce when things are not going as smoothly as you would like them. That's an opportunity. It's an opportunity to pick up more shares of whatever it is that you're investing in because the price is low. So the same amount of dollars buys more shares. So don't do that. Don't stop contributing to your retirement plans. Number 2 on the list of 7, you move investments to cash. Boy, we've talked about this a lot, not just of late, but over the years that we've been doing this program. Moving investments to cash. Folks, the formula is time in, not timing as it relates to your investments. So don't just simply move your investments to cash in reaction to the headlines and those kinds of things that are happening on the media on a regular basis, because that means that you're going to miss out on those types of returns that come only by being consistent and being consistent on a regular basis. Number 3 on the list of the 7 most common mistakes that people make during times of crisis is to focus on short-term returns. We've certainly seen this one play out, and it doesn't play out particularly well if we think back to this notion of chasing returns. And you see it all the time. And in the financial services industry does a great job at doing it. Anytime they see sort of a sector that is increasing in value, that's getting a lot of attention in the mainstream media, what they do is they roll out funds that are sector specific in terms of trying to gather dollars in order to go into those types of funds, because people, human nature, you always like the stuff that did the best of late. The reality is that what that means, though, is you wind up chasing returns on a regular basis. Worst case scenario, or worst time that I've ever seen that was back in 1999, where the financial services industry was bringing out, as you might well imagine, a lot of tech sector funds, a lot of internet sector funds, and at the end of the day, if you check kind of what the market did in 2000, 2001, that did not turn out very well. So be careful about chasing returns. Be careful about focusing on those short-term returns, because they can often lead to some not good periods of time where the returns are not nearly as good as what you expect. So be very careful about that. Number 4, and this one goes to the heart of sort of what the best financial picture really should look like. So number 4, don't borrow money unnecessarily. Don't borrow money to invest in the stock market. We are not fans of using margin in a client portfolio, simply because you're literally borrowing off of assets that you have in order to, in theory, go and get more assets. And we just don't think that that's the right approach, because that's an approach that can, if things turn against you, wind up hurting very, very difficultly. The having to make a margin call or something like that because the value of the securities that were being used as collateral for that loan, it's just very difficult to do, because chances are if you're borrowing on margin, you didn't really have any other cash to invest at the time, and so it can really spiral out very, very quickly. So maybe to buy a house or something like that, of course, that's normal. Okay, you're going to use borrowed money to buy a real asset, to buy real estate or something like that. Sure, that makes sense, because you're using the borrowed money to acquire an additional asset. When you're doing that, then particularly when the rate's at 3 or 4%, that makes a lot of sense. So just be careful about borrowing unnecessarily or borrowing money to invest in the stock market. Number 5, and this is also one depending upon the time, right? If you focus too much on aggressive debt repayment, and let's be very, very clear, we are big fans of making sure that people have their debt paid off. You don't want to be carrying credit card debt or anything like that. Particularly if you can go into retirement without owing anything to anybody, that's the best case scenario. The reality is that when people are trying to get rid of their debt and focus on it, that's a very good thing. But during tough times, you need to kind of have some balance, some perspective, if you will, on it, because when you use your cash to pay off the debt, that means the cash is gone. During periods of time like now, you may want to hold back and hold on to a little bit more cash than what you might otherwise do. And that means that maybe you're not paying off debt quite as aggressively as you used to. And that's okay, because I think right now, particularly during times of uncertainty, during tough economic times, that you want to perhaps hold that cash a little bit more than what you might otherwise do. And then the last 2, and so we will certainly get to those, is not seeking assistance, not seeking out help in these types of decisions. We encourage you to do that. The folks at Vanguard, king of do-it-yourselfers, actually had a study a few years ago that said that if you seek help, get some type of financial person to assist, it can add as much as 3% per year on a regular basis. That's significant. Lastly, number 7, making panicked choices instead of proceeding slowly. That's probably true of anything in life. We're going to wrap it on up and get on out of here. Thank you so much for listening to the program. Those were the 7 more common mistakes that people make during tough times, and most importantly, how you too can prevent them. Thank you for listening to the show. This has been Dollars and Cents with me, your host, Joel Garris of Nelson Financial Planning, here on News Radio Orlando, along with 96.9 today.